The income statement reports the income and expenses of a company, as well as the change in the capital as a result of economic activity during a fiscal time period. Now let's look at Intel's income statement as specified in the 10Q quarterly report as of September 27, 1997. The complete text of the report is given in the appendix of the course. The income statement is also consolidated and unaudited. The income statement shows data from the last fiscal quarter and that from the beginning of the fiscal year. For each category, there are two sets of data. The first is from the current year, and the second set is from the prior year. The first line of the report, net revenues, reflects the increase in capital as a result of the company's activity for a given period. The income is generated via sales of products or services. The next line shows costs and expenses. Listed in Intel's report are the following items: cost of sales, research and development or R&D, and marketing, general, and administrative. The items listed in the cost and expenses section are added together, and the total equals the operating costs and expenses. The operating costs and expenses total is subtracted from the net revenue, giving us the operating income. Operating income equals net revenue minus operating costs and expenses. In order to calculate the income before taxes, it is necessary to take into account some more items: interest expense, interest income, and other. Interest expenses must be deducted from the operating income, and the interest income and other must be added, giving us the income before taxes. After that, we subtract taxes from the income before taxes, giving us net income. So as you can see, Intel has made a quarterly profit of $2.44 billion. Provisions for taxes are $866 million, which we subtract from the quarterly profit, giving a net income of $1.574 billion. When we divide net income by the total number of shares outstanding, we get earnings per share. Out of the earnings per share, some funds are allocated for the payment of dividends to shareholders. The weighted average common and common equivalent shares of Intel are 1.797 billion. The net income is 1.574 billion. We apply our formula and get the EPS in the amount of 88 cents. Out of this figure, only 3 cents per share were paid in dividends. The next section we're going to look at is the cash flow statement. This reflects changes in a financial position of a company for a given fiscal period. As well as both previous financial documents, the cash flow statement is consolidated and unaudited. All figures included in the report are taken from the beginning of the fiscal year up to the time of the quarterly report, which is September 27, 1997. As in all the examples we've examined, the reports are for the third quarter, or a total of 9 months out of the fiscal year. The cash flow statement takes into account 3 basic activities of a company. The first is operating activity, the second, investing activity, and the third, financing activity. The operating activity of Intel resulted in the following: net income, depreciation, net loss on retirements of property, plant, and equipment, deferred taxes, changes in assets and liabilities, which include accounts receivable, inventories, trading assets, accounts payable, accrued compensation and benefits, income taxes payable, tax benefit from employee stock plans, The Employee Stock Ownership Plan, or ESOP, is a system of benefits for the employees of a company. This gives them favorable conditions for the purchase of the company's securities. The next line is other assets and liabilities. The beginning investor might be a bit perplexed with the fact that depreciation is not deducted from the net income, but rather added to it. This appears to contradict common sense. On its face, one should ask, how could the deterioration of the equipment be considered as a source of cash input? Well, in reality, there is no contradiction, and in order to explain this, we must review the idea of depreciation. The physical assets of a company have the unpleasant feature of wearing out, and it is necessary to take this into account. Therefore, there is a depreciation lifespan assigned to each of the physical assets. For example, a computer is assigned a 10-year life, and the cost of the computer is $1,000. Divide 1,000 by 10 years and we get a depreciation of $100 per year. This yearly value is written off, and the process is called, as you could guess, depreciation. A simple definition to remember would be that the depreciation is the process of writing off the cost of physical assets during their service life. So, Intel, at one time in the past, acquired physical assets which have incurred the charges of depreciation. In the cash flow statement, we can see the total depreciation for the current fiscal year is $1.6 billion. Now, what do these charges represent? It should be obvious that Intel did not actually spend this cash. It has simply written it off and simultaneously incorporated the amount into the cost of its products. In short, the depreciation has not created a loss for the company. In the cash flow statement, we deal with the actual income and outflow of cash. This is why the depreciation expenses should be added to the income, reflecting a positive cash flow. For similar reasons, the retirement of equipment and deferred taxes are also added. The second part of the cash flow statement takes into account the cash flows which have arisen as a result of investment activity. These include additions to property, plant and equipment, purchase of available-for-sale investments, sales of available-for-sale investments, maturities and other changes in available-for-sale investments. For this, only two explanations are required. Firstly, maturities are cash flows related to the maturity dates of fixed income securities, such as bonds. Secondly, the available-for-sale investments are treated separately from non-marketable securities because the latter does not circulate in the open market. Finally, the third part of the cash flow statement is connected to financing activity, and it includes net increases and decreases in short-term debt, additions to long-term debt, retirement of long-term debt, proceeds from sales of shares through the employee stock plan, proceeds from exercise of 1998 step-up warrants, proceeds from sales of put warrants, purchase and retirement of common stock, and payment of dividends to stockholders. Additional explanation is required concerning step-up warrants. You remember that warrants are options, which the company issues on its own stock. Options have a performance price or strike price. Usually the strike remains constant during the life of the security. However, there are exceptions. For example, the warrants of Intel can have their strikes raised, hence the name step-up warrant. So, the final result of Intel's cash flow statement for the given fiscal period was an increase in funds of $820 million. Also contained in the cash flow statement is some more information regarding two additional types of cash flow: cash paid during the period for interest and income taxes. At this point, we've considered all three basic financial documents. However, fundamental analysis is not limited to the study of tangible figures, such as those reflected in balance, income, and cash flow reports. A large portion of the fundamental analyst's work is devoted to ratio analysis. These calculations not only reveal additional characteristics, spilling light on the true financial position of a company, but also allow for comparative analysis between companies. In the following section, we'll look at the basic forms of ratio analysis.